Hey everyone, welcome to Money Wire Work. Today we're going to cover how to use one of the most common trading indicators, the Relative Strength Index. Since the RSI is one of the most commonly used indicators for technical analysis, you can find it on most trading platforms such as Thinkorswim, Webull, and TradingView. One benefit of using a commonly used indicator is that it helps you get insight into what other traders are looking for, which helps you catch momentum of these other traders. So what is the Relative Strength Index? The Relative Strength Index, referred to as the RSI, is an oscillating indicator designed to measure a stock's momentum. Traders use the RSI to determine whether a stock is overbought or oversold, which can help determine when to enter or exit a position. The Relative Strength Index is calculated by the average gains divided by the average losses of a particular time period. The value of this calculation is the relative strength, which is plotted on a graph between 0 and 100. When the line on the graph is below 30, the price action is considered to be oversold. When the RSI line is above 70, the price action is considered to be overbought. So how do traders use the RSI? Well, when the RSI dips below and then crosses back above the 30 line, some traders consider this to be an entry point for a long position. Traders shorting a stock can also use this point as a signal to exit a trade. When the RSI rises above and then dips back below the 70 line, traders are either looking to exit a long position or enter a short position. The RSI can also help traders spot trend reversals. A trend reversal can be determined when there is a divergence between the price action and the RSI. A divergence is when the price action moves in one direction while the RSI moves in another. For example, a bullish divergence occurs when a stock price makes lower lows while the RSI makes higher lows. Traders use this bullish divergence to indicate that downward momentum is waning and a bullish reversal may be in the near future. A bearish divergence, on the other hand, occurs when a stock price makes higher highs while the RSI makes lower highs. Traders can use this bearish divergence to indicate that upward momentum is waning and a bearish reversal may occur. One thing to keep in mind when using the RSI is that, like all other indicators, its signals are not foolproof. Certain events, such as macroeconomic events and earnings, cannot be factored into the RSI. Therefore, it is recommended that the RSI be used in conjunction with other technical indicators and a stop loss. On top of that, it's general practice to avoid having an open position through earnings. An exception to that would be if a trader is specifically speculating on earnings itself, which is higher risk trading. In addition, the RSI can remain overbought or oversold for an extended period of time. So even if a divergence is suggesting a change in momentum, there is no guarantee that the move will actually occur. This is why the RSI is best used with other indicators such as volume and an overall trend, which can be determined by a simple moving average. So how do you use the RSI with a simple moving average? A simple moving average, or SMA line, helps determine momentum of price action. When the price action is above the SMA line, the stock is considered to be in an uptrend. Conversely, when the price action is below the SMA line, the stock is considered to be in a downtrend. Therefore, a trader can use the RSI in conjunction with the SMA line by entering a long position when the price action crosses above the SMA line and the RSI crosses above the 30 line. Here, you can see 2 points in Bitcoin's price that meets this criteria. Both instances correctly indicated a change in momentum. If a trader entered long at both of these points, they would have successfully predicted a good entry position. The benefit of using the RSI in conjunction with an SMA line is that it is a simple yet effective way to trade any market. Most traders will usually agree that simple is usually better, as too many indicators or too complicated of a strategy can muddy the waters and cause confusion. Another indicator many traders use the RSI with is the MACD. The MACD stands for Moving Average Convergence Divergence. Investopia describes describes the MACD as a trend following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponentially moving average EMA from the 12-period EMA. On a typical MACD default setting, the MACD line is blue and the signal line is orange or yellow. A bullish crossover is when the blue MACD line crosses above the signal line, and traders use this as an indication to go long. Similarly, a bearish crossover is when the orange signal line crosses over the blue MACD line. This signals the traders to either exit a long position or enter a short position. So how is this used with the RSI? When the price action is above the SMA line, traders can enter a long position when the RSI is above 30 and a bullish crossover occurs on the MACD. Traders can also enter a short position when the price action is below the SMA line, the RSI is below 70, and a bearish crossover occurs on the MACD. There are numerous other strategies implementing the RSI that have been proven to be successful, but these are just a few examples of how you can use the RSI to consistently grow your trading account. Another benefit of using the RSI is that it is an effective indicator on multiple time frames. Some indicators can be difficult to use on smaller time frames like the 1-minute chart. The super trend, for example, is an indicator that many traders consider to be more difficult to use on smaller time frames. This is because it always gives an entry or exit signal. So this can be difficult to track on smaller time frames because these time frames are usually more choppy and less decisive. The default setting for the RSI is period 14. So what does that mean? It means that the indicator is calculated using the last 14 candles of the chart. In addition to that, the common default setting for oversold is 30 and overbought is 70. When using the default setting on the 1-minute chart, it can cause the RSI to reach extreme values more frequently. So therefore, some traders adjust the oversold line to 20 and overbought to 80. While the creator of the RSI suggests using the RSI on its default settings, some traders make these adjustments to help eliminate noise on smaller time frames. These adjustments may cause traders to miss out on some good entries, but the trade-off is fewer high-quality entry signals. If the RSI is something that interests you, try backtesting a strategy using the indicator and see how it performs. You can also research how other traders have backtested the RSI and compare it to how it matches your strategy. If you like this content and want to see more, please like, subscribe, comment, and hit the notification bell so you can see all the latest videos on my channel. Until then, thanks for watching.